You're good to go.
All right. Hello, everybody. It's Coach Holmes. Share screen. Awesome. Awesome. All right. We're giving her now. All right. Okay. We're kicking now. Hopefully you guys can see this. So like I said, you know, trading and investing, obviously two different things, but they share similar traits, just not all the same traits. You know, when we start thinking about investing, we're usually thinking about a longer time frame, or horizon, if you will. Okay. And so the good thing about investing versus trading is trading requires a fair bit of attention. Now, if you learn to dividend invest properly, learn to get into really great companies that are solid, you can get that passive income coming in all the time. Now, a lot of folks, a lot of traders say, well, the dividends don't pay enough return, you know, those kind of things like that. You know, I tend to disagree with that, especially recently with the pullback that we've had, you know, in February there. Some of the dividends for some great companies have just skyrocketed, you know. And the other part of that is when you look at that long term, that horizon, that length of time that you're willing to be in an investment or a trade, if you widen that out over time, what can happen is you can take those. Just bear with me 1 second, folks. More technical difficulties. All right, hopefully that's got that there. My bad. There we go. All right, we're good. Okay, so once we widen out that time frame, you can really start to amp up those returns. Let me give you an example. We talked about this last night on the webinar. Warren Buffett, I'm sure you guys have all heard of Mr. Warren Buffett. Anyway, he was the proud owner of Coca-Cola stocks. I believe he bought them back in 1983. In 1983, he paid $3.25, I think was his average cost for a share of Coca-Cola. Well, their dividend today is about $1.64. Okay, so now that's a bit of a horizon or a time frame, if you will. That's a long time to keep it. But the reality is if you look at those numbers, if you do a little bit of quick math, you're nearing 50% return for him every year just by sitting there and collecting the money. And that's not a bad little thing to do, you know. Now, mind you, it's taken some time to get to that point, but if you start looking at the longer time frame, the bigger horizons, all of a sudden this can be a real good part of your overall portfolio strategy. Okay, it's something I've been doing for years, and it's something that I take very seriously. And really, when you start to amp this up with some cash flow strategies, dividend investing can be just out of this world. Okay, one of the things that I think is probably most important is the companies. Okay, if you're going to buy into a company, you better know or have a very good idea of how solid that company is. Okay, because there's lots of companies out there that pay dividends and that, you know, maybe aren't around 10, 20 years from now. And then there's lots of companies out there that are probably going to be around longer than I am. Okay. And so I think that's what we have to look at first, is we have to look at the strength of the company. So for me, I always go to the fundamentals first. And again, this all has to be part of a trade plan like anything else. If you're starting to think, okay, well, maybe I've got a time horizon of 10 or 20 years, okay? Let's say 20 years down the road. Well, you're going to have to look at something and you're going to have to say, okay, how strong is this company that I'm willing to buy into? Will they be around more than 20 years? Will they be around longer than I will? These are all questions you want to kind of ask yourself. And they're very, very important. Now, a lot of people think, geez, you know, that's a lot of research to figure all that out. Well, what I'm going to do for you guys tonight is I'm going to nail it down to about 2 or 3 items. Okay, I've called this system over 10 plus years now, maybe 15 years now, and I've nailed it down to about 2 or 3 specific things that we look for that can tell you the health and strength of a company. Okay, and I'm going to show you guys all that stuff. So when we talk about strength, we're talking about fundamentals of the company. You know, how strong are they? How long have they paid dividends? What's their dividend yield? All these kind of things come into play. You know, so fundamentally speaking, there's a couple of things that I look for. Okay, first of all, I'm looking at products. Okay, so if a company has a product that a lot of people use over and over again, and even has the ability to, I guess the term is probably recession proof. Okay, if you have a recession proof product, okay, let me see you guys type in the chat. What would be a recession proof product? Something that even if times are bad, economically speaking, what's still going to be around? What are we still going to use? Okay. Anybody? Recession-proof products. Just give me a couple of staples. Okay. Yeah, that's maybe. iPhones, Keith. Okay. Not exactly where I'm going with this, but I think a lot of people would agree with you. Okay, Jimbo, toilet, TP. Yeah. Staple items. Yeah. Healthcare, food, Coke, electric. Yeah. Yeah, so you guys are on board. The way I look at this is, when I start thinking recession-proof products, I'm thinking, A, I got to eat. B, I got to brush my teeth. C, I'm probably paying my mortgages or my debts. So some banks may fall into that situation as well. Jersey says liquor. Yeah, okay. I'm not going to go down that rabbit hole, but you may be right there. Cigarettes and marijuana. Thanks, Jimbo. So all of these 5G, yeah. So a lot of these things, I think you guys are kind of on the right track here. Internet, yeah. Mike said internet. I think that's a good one as well. I think that the days of living without internet are pretty much over as far as I'm concerned. But when you start thinking about all these things, you say, okay, well, what company provides us toothpaste or toilet paper or all these things that we cannot live without? What provides us soft drinks? Well, we got the two big players. We got Coca-Cola and Pepsi. Well, once you start to nail down these companies with this. All right, something's going on here. When you start nailing down these companies with these great fundamental, this great fundamental strength, if you will, then all of a sudden you can start to do a little bit of research and find out, what these companies are and what they provide. Okay, that's really what this comes down to. So once we have that, then we can start to look at things a little bit differently. Once we find these companies, then we can start to look in a little bit deeper, and we can say, okay, well, if they have a recession-proof product, what else do they need to have to be solid? Okay, so for me, hold on here. I got something going on here, funky. For me, what they have to have is they have to have a history, okay, of strength, okay? And when I say strength, for me, that has to be a history of dividend payments, okay? They've got to prove to me that they can pay dividends through thick and thin, okay? It's like, it's like saying to your, one of your buddies that's always there for you. No matter what's going on, you've got that one buddy that's always there for you. That's the kind of thing that you want to count on. You've got that long-term strength, and you can see that, and they've just come through everything, and they're still always there. Those are the kind of stocks and things that I want to look at. If I can't find those companies, then how do I know that they're going to be there down the road? Okay, so products, we want recession-proof products. We want a history of strength, so dividends through thick and thin. And then finally, for me, cash is king. Okay, so what I want is a company or companies that have lots of cash. Okay, because the reality is when times get bad, if you've got lots of cash sitting around, okay, you can weather a lot of financial storms. Okay, you can get through things, and things that maybe take smaller companies out, or companies with large amounts of debt. Those things that you can weather that storm where some others might not be able to. If you start looking at these three things, all of a sudden you can start to say, hey, okay, if they have all of this fundamental strength here, perhaps maybe it's something we can take a look at. It's something that we can say, hey, maybe we can build a passive income stream from this dividend investing. Okay, so Jimbo throws in Apple there, right? So You know, Apple has a boatload of cash, no question about it. Do they have a history of dividends? Well, I think they've only been paying dividends about 6 or 7 years now, if memory serves. That's really not quite where I like to have it, but each investor is going to be a little bit different. Now, the recession-proof product thing, we can have a discussion about this all day long. For me, if I had to choose between eating dinner and having a new iPhone, I'm probably going to go with the dinner thing myself. But hey, maybe those iPhones are very important. So when we come up with these kind of questions that we have to ask ourselves, this is when we can start to go out and we can use these tools to find, you know, the information we need, and we can cut through all the tape. Okay, we don't need to, you know, I'm not going to spend hours, you know, going through all of this stuff and just to figure out if a company's solid or not. What I can do instead is there's some tools that I use, and the first place I go is Yahoo Finance. I'm sure all of you have used Yahoo Finance in your time before. It's a nice, easy website. It's got everything we need to know at our fingertips. So let's see, a company that's very solid. I'm going to get you guys, give me a ticker symbol of a company that you think is very solid. Any company. Just think about the criteria that we've talked about here. So we got recession-proof products. So I got Dow, T, KO, right on. Let's start with KO. I like KO. It's one of my favorites here. All right. So when I start looking at this here, like I said, there's a lot of information here. You guys can see there's like 10 different choices across the top here. I don't want to have to go through all that. I'm not really concerned about that. What I'm concerned about is the financials of the company. So for anybody who hasn't really, you know, drilled down to looking at fundamental analysis, basically you can figure out whether it's a household, whether it's a company, whether it's a country, you can figure out very quickly if somebody's in trouble. And the way you can do that is you can look at, are they making money? Are they losing money? Are they in debt or are they out of debt? Do they have lots of cash on the balance sheet? That's really what you're looking for, okay? So we can't see your screen still on Word doc. Okay, thank you, John. All right, let me see if I can fix that for you. Let's go to new share and we'll go to screen. All right, come on. All right, can you guys see it now? Got it? Beautiful. Beautiful. All right. So like I said, all I did was go to Yahoo Finance. I threw in the ticker symbol, and then it gives me all of these different choices across the top here. Summary, charts, conversion, statistics, all that stuff. I don't need to know any of that. I'm going to cut through the chase here. We're gonna nail down to what we need to know about this specific company. Okay. So when I go to financials here, what I have is I have an income statement, a balance sheet, and I have cash flow. And those are really the three things that I'm most concerned about. Okay. On the income statement, really, I'm going to drill down very quickly here. I'm not going to spend a lot of time on here. What I want to know is, are they making money, and is that money that they're making increasing? Okay. So what you guys will see here across the top, and we're just drilling this down real quick. You've got 2016, 2017, 2018, and 2019. Okay, and that TTM at the end means trailing 12 months. We're not going to bother too much with that. What I want to look at is those four that they've already given us. And I want to go down to the net income, and I want to say, okay, what's happening with their net income? Okay, so net income, after you take away all the other stuff, it's how much money did they make? Okay, and there's lots of other metrics on here. Again, I don't really need to drill down that far. Okay, so 2016 they made 6.5 billion. 2017 was 1.2 billion. I prefer to see that rising. 6.4 billion in 2018 and almost 9 billion in 2019. Okay, so as you can see, Coca-Cola is in a pretty good position from the standpoint of actually making money. Okay, they did have a little dip there in 2017, but really they're still increasing. You look at the trailing 12 months there, and it's even higher than what they got there. Okay, so all of a sudden I can look at this and I can be pretty confident that these guys know how to make money. Okay, is that fair to say? Are we all on board with the fact that Coca-Cola knows how to make money? Pretty much every country in the world that you go to, you can see a Coca-Cola sign or bottle or something. So I think that's fair to say. Now, if we go to the balance sheet, what I want to look at the balance sheet is all I'm really concerned about is assets versus liabilities. So if you guys think about your household, if you're carrying too much debt and you don't have enough income, is that a recipe for disaster in the long run? Typically it is. Jimbo, expensive sugar water. Yeah, it is, but there's lots of people paying for that expensive sugar water. So when you start thinking about debt versus income, or basically in this case, assets versus liabilities, really what we want to make sure is that the assets that they have are more than their liabilities. Okay, so we look at this, and we look at total assets. Okay, recently it was we'll use, I think that's 20. Let me just look here. Yeah, so 2019. So they got about 86 billion in assets. Okay, so now if we go to their total liabilities, okay, they've got 65 billion in liabilities. So what that essentially means is we could take all their money, or take all their assets, sell all their assets, get rid of all their liabilities, and they still have what was that, about 20 billion left, somewhere in that. Yeah, so yeah, $21 billion left. And that's if they got rid of it altogether. Okay, of course they're not going to do that. But what that shows you is, worst case scenario, they could close up shop and still have $20 billion sitting behind them. That's a pretty good deal. Okay. So now all I want to do is I want to look at cash flow. And as I was saying to you, cash is king. What I want to know is, how much cash do these guys have? Okay. Do they have enough to get through whatever comes at them next? So a coronavirus, a recession, whatever's coming along, do they have enough to get through there? Well, if we go to this last one called free cash flow, okay, so that's cash flow after everything else is all settled and done. And we look at this, basically these things have been increasing all the way along. Okay, little dip here in the last year, not quite as much as 2018, but they've got 8.2 billion in free cash flow. Okay, so you guys can see that that's met all our criteria here. We've got our products recession proof. Guess what? People are going to drink sugared water even when times are bad. We got cash is king. And then all we got to do now is we got to figure out if this has a history of strength. Do they pay dividends? I know that they do. A lot of you probably do as well. But how much is their dividend, and how long have they paid it? This is where things become super, super important, key, if you will. Okay, and this is kind of the last piece of the puzzle for me to decide whether something's strong enough that I'd be willing to buy into it, right? So for those who are new, who don't really understand dividends, all it is basically a reward for being a shareholder, okay? So they take a little bit of the profits, and they take them and they spread them out to the shareholders, and they say, hey, thanks for owning the shares, here's your payment, okay? And what it means to us investors is that we put out some risk capital, and every quarter, or some stocks paid monthly, every monthly, we're getting some of that risk capital back. What we're doing is we're reducing our cost basis, okay? And that's very, very important, because ultimately, if I asked you guys, how much free stock do you want, what would be your answer? I would hope that answer would be all of it, okay? And the reality is if you sit there and collect dividends long enough, you will eventually own the stock for free, okay? And that's really what we're after, okay? As I use the Buffett example, you can, he paid $3.25 for his stock, and he gets $1.64 every year. So in 2 years, he's paid for it all, right? So yeah, all of it, yep, all of it plus some. Yeah, there you go. So Ahmad asks, so do you have to be in a trade and investment for a period? Well, that's the thing, okay? If you're going to collect these dividends, you are going to be holding this, okay? So you've also got to have a plan for that as well, okay? Now, if it's a really good company, You can sit through the ups and downs of it. Okay, that's usually, you know, depending on the company, you can do that. Of course, you guys are traders. Okay, you're tackle traders. You guys can do better than that. You know, having a dividend, whatever Coke pays, which we'll find out in a minute here, having that dividend is nice. But is there things that we can do to church that up a little bit to increase that? Absolutely, there is, and that's what we're going to talk about tonight as well. Okay, you can take these things, you can take these great dividend paying stocks, and although they're not going to pay you 3 to 5% a month typically, they can still pay you a decent return. And then if you add that all up at the end of the year, all of a sudden, you know, you're starting to create some serious cash flow. Okay, and you're starting to knock down that cost basis in a meaningful way, so that instead of waiting, you know, however long it takes just to get the dividends, what if you started selling covered calls? Even if you sold, you know, 3 or 4 covered calls a year, even if you're not that active, if you're more on the investor side and less on the trader side, if you start buying, you know, or selling a few covered calls on these things, all of a sudden you're going to knock that cost basis down in a heck of a hurry. Okay. So Bharat says, how do we find historical dividend? Great question, Bharat. That's where we're going next. Okay. So I have a little website I use. There's lots of them. I'm going to give you a couple of them here. So dividend.com has got some cool stuff to it. I don't use it quite as often. Where are you here? So if you put into a ticker symbol here, we'll throw in Coke, and gives you a bunch of stuff here. This gives you a little bit of data, okay? Tells you the annual yield, the 3.54%. Doesn't give you the payout ratio, all this kind of stuff, okay? This dividend.com has some good stuff to it. Of course, they want you to sign up for premium. I have a better website than this that I use, okay? I give them this to a few of my mentor students. Dividendinvestor.com, okay? You can find out some information on Yahoo, but I find dividendinvestor.com to be far superior to anything else, okay? So if I go and I throw in Coca-Cola here, and I hit the old go symbol here, all right, what it's going to do is give me a plethora of information on Coca-Cola, okay? Some things that I want to point out to you, and hopefully you guys can see this. My YouTube seems to be a little bit slow. Trailing 12-month dividend yield. So right now, if you were to buy Coca-Cola at 45.21, you would get, just from their dividends alone, about 3.63% return over the course of a year, okay? You can see that the dividend rate is $1.64. So basically they pay it quarterly, so they split it up. You can see the current dividend amount down here, 0.410, so 41 cents every quarter. Those are not the most important things to recognize in my estimation. The things that I look for, dividend yield's important, obviously. What I look for is a couple of things here. One is the dividend payout ratio. All right, so I'm going to ask you guys a question. Who here knows what a dividend payout ratio is and what it means? Let's see who the A students are in the class today. I don't know, is it me or is that chat slow? No. I see a question mark, crickets, yeah. Okay, all right. So all right, I'm guessing nobody's answering that then. So a dividend payout ratio is basically the percentage of earnings, okay, that they pay to the dividend itself, okay? So Dennis says percent of net income going to dividend payments, right? Very good. So just a little, so the percent of revenue is given back, basically, very much, yeah. Okay, you guys got it. So essentially, basically, how much money are they taking from what they make and then giving it back to the shareholders? Essentially what it is. There's a reason that ratio is very, very important, okay? That's going to give us a heads up as to whether the company can continue to pay the dividends that they currently are, okay? So one thing that I want you to notice about this website is they have something called a dividend all-star ranking here. If you look down at the bottom on the left-hand side, okay, this one has 5 stars. Essentially what that dividend all-star ranking means is I'll show you the legend down here. Okay, if you have 5 years of consecutive dividend increases, not just payments but increases, you get 3 stars. If you have over 20 years of consecutive increases, you get 5 stars. Okay, well, as you guys can see, Coca-Cola has paid consecutive dividend increases for 57 years. Okay, so for all of you investors out there who worry about inflation and things like that, this is something that tends to keep up, not necessarily at exactly the same rate, but those dividends tend to get bigger over time. Okay, so it's kind of like a little offset to inflation, which is kind of nice. So even if you're one of those passive investors where you're not doing, covered calls or naked puts or those kinds of things, even if you're not one of those investors, just sitting back and collecting the cash, you're going to get a little bit of a bump each year from the really good companies anyway. Okay, so that I think is pretty cool. The first dividend paid was 1893. So remember the second thing we talked about. Okay, history of strength. Okay, they've paid dividends, never missed a dividend payment since 1893. That's a long time ago. They've had 57 years in a row where they've increased their dividend. Okay, so if you think about what we've gone through in 57 years, okay, we've gone through several market crashes. Okay, we've gone through conflicts overseas. We've gone through a lot of economic events, and yet the tech bubble, 1987, all this kind of stuff, and yet this company has been able to pay consecutive increasing dividends over and over again. Okay, that tells you that you've got a history of strength. So if we start looking at our criteria, recession-proof products, I would say that qualifies for Coke. Long dividend history or strength, I would say that definitely qualifies. And then as we said, when we looked at Yahoo Finance, we've got 8.2 billion in free cash flow. Okay, if you look at all of these things, does that not tell you that Coca-Cola is a pretty strong company? Okay, so Ahmad asked, the 164 is per share on an annual payout. That's correct. They pay quarterly 41 cents per quarter, Ahmad, and they pay out 4 times a year, which is $1.64. Okay. So Dogfin says, I'm currently doing drip, not sure which is best. So again, for that's an individual choice. Okay, love drip programs. That's how I started way back when. For those really truly passive investors, drip program. For those who don't know what a drip program is, it's a dividend reinvestment plan. Okay, you can get them through your broker, or you can actually get them through their company. The company will have another company that kind of manages those programs for them. It's kind of like a set it and forget it investing tool. Okay, and so it's to each their own. Personally, drips, like I said, if you're really, really passive, they're awesome. If you're more of a trader like myself and a lot of the folks here, when you want to start doing those covered calls, you probably want to have control over those. You probably want to have them into your brokerage account so that you can start doing things with them. Unfortunately, with drips, you can't really do much of that. Okay, but again, that's kind of each their own there. So when we start looking at this, we can see that, okay, if we can find these good quality companies, okay, then we can start to build up a little portfolio of really great stocks. Okay, now the question becomes, can we make any money? Can we church this up a little bit? So if we think about this, 3.63% per year isn't all that stellar, right? Like it's not knocking it out of the park by any stretch of the imagination. Okay, so if we start to think about this, we say, okay, well, maybe we can start churching this up a little bit. Okay, for all of you who have ever done covered calls, and for those who haven't, okay. Basically, when you start doing covered calls, they're going to be a little different maybe than what you're used to. I know that we talk about the 40 delta, selling a 40 delta covered call, those kind of things. What you got to do when you're starting to invest is you got to start to think about some different things. Okay, first of all, if you're not that savvy at rolling calls and things like that, then you're going to probably want to find a lower delta to sell your calls with. Okay, I'm trying to get my my Coca-Cola to come up here. It's Thinkorswim's being the bane of my existence again today, so just bear with me. All right, so I saw some questions here. Let me answer the question. So what percentage do you look for in the dividend payout ratio? Great question, Alan. I don't look for a specific payout ratio. What I look for is, well, I shouldn't say that. The lower, the better, okay? But if it's a certain company, I don't really get too worried about it. So Coca-Cola is an example. We looked at the net income of Coca-Cola, okay? Their net income was huge, okay? And they still had a 70% payout ratio. But if we look at how much free cash flow they have on hand, they can afford to pay those dividends, okay? So Ahmad said some companies have higher payout ratio. The ones that start to scare me is when you start to get over 90%, over 100%, you know, those ones there, that's where things get a little bit worrisome, okay? So let me ask you guys, can you see my Thinkorswim, or can you guys still only see the dividendinvestor.com? Okay, yes, just TOS, perfect. Okay. So like I was saying, if we start to look at this, and let's say we own some stock, okay, there's a couple things we got to think about, okay? First of all, the reason we're doing this is because we want the dividend, okay? So if we want the dividend, what do we have to look at? What do we have to be careful of? Well, for me, what I want to be careful of is when that dividend is paid, okay? So this Thinkorswim is so slow. My apologies for this, you guys. So if we know that a dividend's coming up and we're selling covered calls, okay, you have to be very, very careful, because if you sell a covered call and it's in the money or close to the money, then someone can call your shares away and take that dividend. So if you're starting to build this up and you're starting to say, okay, I want to start building a portfolio of good dividend paying stocks, okay, I want to do this, and I want to make sure that I hold those stocks so that I get these dividends that I'm after, then you have to strategically start selling covered calls. Okay, so you can see here that they just paid a dividend on the 12th of June. Okay, so they're going to pay another one in 3 months. So June, July, August, September. So they're going to have another one in September. Okay, so for the next 2-3 months, depending on when it falls, okay, you can start selling some covered calls on this. Well, let's see what we can get for a covered call on Coca-Cola. Okay, we'll assume that we bought it today at 45.07. Okay. So, you know, if you follow the typical rules, we talk about closest to 30 days, you know, kind of 40 delta-ish, okay? Typically when I'm doing this for, you know, kind of a dividend thing and less of a cash flow thing, I like to go a little bit further out on the delta, okay? So let me get closest to 30 days, which would be August 7th. I'd love for this Thinkorswim to work a little faster for me, but so be it. So typically what you're going to find with blue chip stocks like this, stocks that pay, you know, consistent dividends year after year, the yield can still be pretty decent. Okay. All right. Just I don't know what's going on with this thing. This thing is unbelievable. All right. Finally getting some numbers here. So let's look at, say, a 30 delta. Okay. So if I sold a 30 delta, I could get about 52 cents out of that, okay? So now if we start looking at this as an ROI, so that's 30 days out, that's a month, right? Okay, we're not too worried about another dividend because it won't be coming up for 3 months. So we take 52 and we divide it by 45.07, which would be our cost basis. What we're looking at, excuse me, is about 1.3%. So 0.52 divided by 4705, sorry, 0.52 divided by 4507 times 100. Sorry, this is just not playing ball with me, folks. 4507 times 100. So we're looking at 1.15%. Okay. So if we could do that, let's be very conservative here, because obviously we're gonna have dividends. Maybe there's 3 months that we don't do this. Okay. We don't want to get our stock taken away, and we don't do this for 3 months. So for 9 months, we do that in a row. That's 10.38%. Okay. Then we got to add our dividend payment on there of 3.64%. All of a sudden, we're sitting there at 14% for the year. All right. How many here know what the rule of 72 is? The rule of compound interest. Anybody here heard of that? I know some of you have. When you start thinking about, how you're going to build a portfolio over time, you're going to use that number. You're going to compound those gains. Okay. So Hartman says yes for Patricia. Yeah. Okay. Pretty much all of you have. No. Okay. Ahmad hasn't. John has. Yeah. Okay. A lot of you have. So yeah, years to double your money. Well, if you take 14% and divide it by, 72 divided by 14, 72 divided by 14, that's 5 years. So a little over 5 years, and you doubled your money in this at 14%. Now, is that a decent return? Let me know where you guys are at when it comes to that. Is that a decent return? Would you guys take that if I offered it to you? I would think that you would. For most people, you would. I know that when I first started investing, all I was doing, thanks, Jimbo. All I was doing was investing in dividend-paying stocks, and some of them paid, as low as 1-2%. Okay, so you can see here, that's just one example. Okay, Ahmad, better than the bank. Well, yeah. So not only is it better than the banks, but it's better than bonds. Okay, it's better than a lot of things. You know what I mean? Like, honestly, if you went and sat down with a financial advisor today and you told him you wanted him to get you 14% a year, you'd probably get laughed out of his office or her office, as the case may be. Okay, but these are things that we can do just by setting ourselves up. Now let's look at another example here. I'm going to go back to dividendinvestor.com, and let's throw XOM in there. So ExxonMobil, I'm sure you guys have heard of ExxonMobil. Okay, so we're going to go back. I'm going to go back to Yahoo first. Okay, and we'll just go through this little example here. All right, so Exxon, $43 stock. So we're going to look at the same thing here. We're going to go back. We're going to start with the income statement. Can you guys see? Can you guys see my Yahoo? Just make sure that we can. Hopefully you guys can see it. So just a little bit of a lag here between the YouTube and this. Okay, you guys can see it. Great. Okay, so net income. Net income, kind of a bit all over the place here, but they made $11 billion last year. Okay, that's a fair bit of money. That means that they know how to make money as well. Okay, so balance sheet. Let's see how healthy they are. Okay, so total assets $362 billion. That's good. Okay, total liabilities. Total liabilities $163 billion. So they've even got more assets and more overall wealth, if you will, than Coca-Cola. Okay, so their liabilities were 362, and their assets were 362, and their liabilities were 163. So they almost got 200 billion. Okay, so 200 billion they've got sitting there. Okay, so now let's see if they've got any cash, because we don't want them to be cash poor. So we go down and look at their free cash flow number. They don't have as much as I'd like to see. They've actually got a declining free cash flow. So that means they're struggling a little bit. Okay, which Ahmad said the energy sector is down, and it is. Okay, but that's still $2.5 billion, plus they've got 200 billion in assets. Okay, not bad to look at. Now let's take a look and see what they look like from a dividend standpoint. So trailing dividend 8.5% or 8.05%. That's pretty sweet, right? Okay, they've got a dividend all-star ranking 5 stars. They've got consecutive dividend increases of 37 years. They actually have been paying dividends longer than Coca-Cola. Coca-Cola was 1893, I believe. These guys are 1882. Okay, so a pretty decent company. What's the only problem that I see with this? What gives me a little bit of concern? What would give you guys a little bit of concern about looking at this company? Okay, they are beaten down right now because the sector is struggling, no question about it. Okay, what would be the big concern here? Because I'd love an 8% dividend. Okay, I'd absolutely love an 8% dividend. Dennis nailed it. They have 130% payout ratio, dividend payout ratio. What that means is not only are they taking all their profits and spending it to get those higher dividends, get those increased dividends, but they're actually using up some of their cash to do it as well. Okay, so one of two things has to happen here. Okay, Ahmad, so lower the share price, higher the dividend, it's good. Well, kind of, yes, you're right there. The lower the share price, the higher the yield. However, you have to be careful about whether they're able to pay that. And this is why I brought up this example for you guys. Okay, at 130%, there's two things that have to happen. Either Exxon has to earn more to be able to offset that, which would bring their dividend payout ratio down, or they've got to cut their dividend. Okay, basically, yeah, Jimbo, they're paying people to own the stock, essentially. Okay, which is what dividends really are in the long run, right? So, like I said, the concern is can they keep this going for the future? Well, let's say they can't. Okay, they have so far. They've done quite well. If you look at their little graph here, they're very good at increasing their dividends. Okay, all the way back to the tech bubble of 2000, they're very good at increasing their dividends. Okay, however, can they continue to do that? Well, with the energy sector struggling, that may be a concern. Okay, so these are some of the kind of things that you want to think about when you start looking at this stuff and you say, okay, is this company strong? Are they going to be around for a long time? Well, it's just common sense questions, right? You don't have to make this very complicated. There's lots of other metrics we could look at all day long, but really you can drill it down to make it very, very simple. Okay, and then what you can do is you can start splitting up a portfolio. So let's say you've earmarked a certain amount of money to a portfolio. Let's say you've got 100K. Okay, you could start sectioning off, say, okay, maybe I put 30% of that into Coca-Cola, maybe I buy some, Procter and Gamble, maybe I buy, whatever else you can kind of think of. And then maybe you say, okay, well, I like XOM, but I don't want to bet the farm on it, because if it does change, if they do cut their dividend, then that could be problematic. Okay. So Jason says, hopefully the XOM and Amazon Alexa gas stations become a hit. Yeah, is that actually a thing, Jason, or is that tongue in cheek? I hope that's tongue in cheek, because that would be hilarious. But anyway, so like I said, the only thing you got to look at, and this is where you could start to dig a little bit deeper as well. Okay, so what you're going to find is you're going to find some companies that hold a lot of debt. Okay, Amazon being one of them, actually. I'm not sure how bad their debt is now, but a few years ago they carried a lot of debt, because basically what they did was they borrowed money to buy these other companies. Okay, that was kind of their business model, which worked really well for them. As they grew bigger and bigger. The problem is sometimes when you borrow money to buy other companies, it can adversely affect your stock price. However, for me, I'll probably never own an Amazon because it doesn't fit my criteria. Okay, is it recession proof? Maybe, but I think their business slows down, and as you guys can see here, they don't pay a dividend. Okay, so would I trade Amazon? I do all day long. Okay, but would I own it? And this is where you got to kind of ask yourself, am I looking for a trade, or am I looking for an investment? Okay, they can be, they can have parts that are similar. Okay, but the reality is you have to ask yourself the time frame. And this is where I think one of the things that I see with a lot of students and a lot of community members is they don't give enough thought to the plan that they need when they start thinking about these things. one of the things that I like to do is I like to, trade on really high quality stocks. Okay, do naked puts, cover calls, those kinds of things, and then take that, premium that you make and start pumping it into building a stock position. Okay, so think about it. If you were selling some naked puts on Coca-Cola, maybe 2 or 3 months in a row, you don't get them put to you. Well, you collect all that premium, then you start funneling that into buying some shares. Okay, so these are little ways, little tricks and tips that you can do to really start building up these things. But the first thing you need to do is you need to look at and set yourself some goals. If you go on the Tackle Trading website, we got the compound interest calculator there. Check that out. Start throwing in some numbers there. Say, hey, maybe if I owned 500 shares of Coca-Cola or 1,000 shares of Coca-Cola, what's it going to look like in 10 to 15 years? Okay. And you can use those trading profits that you have to build that potential for you. Does that make sense? Jimbo says boomerang. Yeah, love the boomerang trade. Okay. Now, the only part of the boomerang trade is the fact that you have to give the stock back at some point in time. Okay. If you're sitting there wanting to collect the dividends, then you may not want to boomerang them back. You might just want to work on collecting them. You know what I mean? So these are just little things that we can do. Do you guys have any stocks you want me to look at, kind of look through here? Anything else you guys can think of that are quality companies? Some companies are, I find it, interesting. One of my favorites that I like to slag on, Chipotle Mexican Grill. So they're a burrito place that their current closing price is $1,109 a share, but they don't pay a dividend. Okay, so I find that very interesting. There's lots of companies out there. This is kind of how you got to kind of look at this. You got to say, okay, do I want a high flyer where I'm making some, capital gain trades on, right? Or do I want some more passive investing dividend income, right? This is where you've got to separate those two. So we got one, Johnson & Johnson. Let's take a look at Johnson & Johnson, another favorite of mine. Okay, so remember Johnson & Johnson. Okay, clicked me back to Apple there. So Johnson & Johnson. Okay, so we look at this, we say, okay, 2.83% dividend, not too bad. Stock price is $142.85. This is the other thing about dividend investing. If you've got a really big size account, if you got lots of capital behind you, then you can start looking at these big dollar stocks. For myself, I try and keep them under about 70, 80 bucks. There's lots of good stocks out there that you can look at. But Johnson & Johnson, 57 years consecutive dividend increases. 1944 is when they started. Dividend payout ratio, only 60%. They can maintain that 60% ratio for a long, long time. Now, if you don't know much about the company, if you scroll down on this website, it will tell you everything everything you need to know and then some. Okay, personal health care, beauty, over-the-counter pharmaceutical, all that stuff. It basically tells you. It also tells you if they have a dividend reinvestment plan. Okay. So, all these kinds of different things, you can check that stuff out. So got a couple of other ones coming in here. So VZ, so let's look at VZ versus TELUS, AT&T. That's a good little comparison. Okay. So Verizon, 4.47% return, paid since 84. Doesn't have the 5-star, but it's got 4 stars. 15 years of consecutive dividend increases, payout ratio 55%. Okay, so if we compare that to AT&T, I can get that to go in there. Okay, AT&T, okay, paying a higher dividend, so 6.87% or 86%, paid since 1881. So this is Ma Bell, been around a while. Okay. 15 years of consecutive increases. The scary part here is this dividend payout ratio of 105. Okay, so this is where you have to ask yourself. You have to say, okay, well, I'm going to get a little bit more out of AT&T from a dividend perspective, but the payout ratio is kind of a bit scary. Okay, so you could ask yourself, well, do I want a little bit more security in VZ, or I'm willing to take a chance that the dividend might get cut from AT&T? Okay, so those are the things you want to kind of ask yourself and see where you're at. The other part of this is you want to look at the stock prices. So AT&T is $30, and I think VZ was 40 something, wasn't it? VZ was 55. Okay, so that's another criteria where you're going to ask yourself. Okay, so T is the better long-term bet. I wouldn't go that far, JT. The only concern I have, like I said, is the 105% dividend payout ratio. Now, I personally think that they'll increase their earnings and that'll come down, but I would say that the VZ is a little bit more stable. Okay. Good question at Coach Gino. All right. So did I miss some questions here? All right, looks pretty strong. So BAC, yeah. So what is a healthy ratio? Again, I don't have a number for that, Ahmad, because some of them have higher ratios than others. Like I said, if it starts getting up around that 80, 90, 100%, that's where it's not like I'm going to turn them away if they've got all the other stuff, but I might take a little smaller position size. Okay, so we got a couple in here. So Bank of America. Okay, so Bank of America, 3.13%, first dividend paid 1903, consecutive dividend increase is only 6 years. Okay, the banking industry, 6 years ago, what was it 6 years ago? So yeah, so basically in 2008, 2009, they actually cut their dividend. Okay, and they hacked it. They went from 2.24 down to 4 cents. Okay, for me, and this is a trader decision. For me, I wouldn't touch them. Okay, if I'm going to go out and put out some money, why would I want somebody who's cutting their dividend? I'd be more concerned. Like I'd be more excited about someone who can keep it increasing their dividend as opposed to cutting it. Okay. So, another good example of that was GE. Okay, so GE was a great dividend payer for many, 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 many years, and then they got themselves in trouble and they've cut their dividend. Well, if they've cut their dividend, do we really want to be in there for a dividend investing play when they've basically said, okay, we've got to restructure our business, things aren't going as well as we'd hoped, then we got to look at it and say, okay, maybe there's a better choice out there. Okay, so again, you don't want to just look at the dividend history. You want to look at the other stuff too, the other fundamentals. You got to look at the cash flow. You got to look at the balance sheet and income statement. You can compare almost apples to apples when you start looking at companies with the same or very similar share price, but maybe one's got a little bit more assets than the other. Again, that's just very basic fundamental thinking. If I were going to invest in anything, I want a proven track record of them to be able to take assets and create money from it. Okay, and we saw that in Coca-Cola, we saw that in XOM. You can see where these people that run these companies can do a very good job of this. And this is really, if I got to put my hard-earned dollars to work, where do I think it's going to be the safest? Okay, so. So we got Pfizer. Let's take a real quick look at Pfizer here. So Pfizer, almost 5% dividends, 1901, so 9 years. So that's so dividend payout ratio is 53%, 9 years. So we got to look back and say what happened 9 years ago. So 2009, 2010, they struggled a little bit. So what that tells me is that maybe they're not as recession-proof as we'd like them to be. Okay. But they do their best to keep the dividends rising. They just struggled during the rough time. So like I said, when you start comparing strength to strength, okay, I would say that a Coca-Cola is a lot stronger than a Pfizer. Okay, just because they've gone so long without having to cut their dividend. So let's got a few more here. Let's go KHC. KHC. So 5% dividend, Kraft Heinz, 0 years. Okay. So this is something that you want to look into, okay? So basically, they cut their dividend in 2019. For those of you who haven't looked at this, they went through they had some problems. They had some SEC problems. They had some restructuring problems. They had some accounting irregularities, I guess you call it. And so they had to do some restructuring. And this is why their dividend history looks like it does. When these two were separate companies, they were both really good dividend payers, but they had to kind of work some stuff out. Well, that is reflected in their share price as well. Okay, so you may or may not want to get involved with this. Again, that's a trading decision, but you got to understand why. This is where if you see something like this, you can start looking a little deeper. Okay, you can start looking into it, say, okay, what's happened to the company? Do I still think it's solid? Maybe if you look at their other fundamentals, it still looks good, but these are questions you have to ask yourself, okay? So BP, somebody asked for BP. Let's look at broken pipe. All right, that's a little joke there. I'm not sure everybody's going to get that one, but hopefully, if you remember the spill many years ago, that's where that came from. So almost 11% dividend. Look at the dividend payout ratio. Like that number almost doesn't seem to be true. Okay. Yeah, like that's insane. Okay, I didn't know where they're getting the money for that. Okay, so if anybody's cutting their dividend, see, now this is one of the problems as well. Okay, looking at BP, it's a foreign company. It's not an American company. So this dividendinvestor.com is strictly for American companies. If you're looking for Canadian companies, which is where I reside, there's dividendinvestor.ca. If you go to the bottom of this website, it does, or used to. Yeah, it doesn't give them any more. They used to have flags at the bottoms of these. Might be able to get it on dividendinvestor.ca, where you can actually go to the company, or sorry, the country where these things are from, and you probably get better data from it. Okay, but again, looking at, if we started comparing, BP to XOM, look in 2010, BP had to cut their dividend. Okay, then they had to keep it the same for a couple of years, so it looks to me like they're struggling a little bit more than XOM. And of course, as we could see, that dividend payout ratio is insane. Okay, so these are the kind of questions, if you ask yourself, you can say, oh geez, I don't know, that seems a bit risky, right? So somebody said Lowe's versus Home Depot. That's a good one. The builders are doing well right now, so let's check out Lowe's. Okay, so 1.63%, okay, for Lowe's. Dividends paid since 61, 58 years. So I like it. Look at the dividend payout ratio. Tiny, very, very tiny. So the ability of Lowe's to continue to pay their dividend, pay increasing dividends, is probably really good. Okay, it's very, very safe. Now, I'm not thrilled about the 1.63%. That might be a misnomer or a no-go for some folks, but this looks very, very secure just from the numbers, okay? So let's look at Home Depot, because it's always good to compare apples to apples, okay? So Jimbo says, don't chase yield. Yeah, you know what? One of the truths about dividend investing is typically the higher the dividend, the more risk there is to the stock. Okay, now that's not 100% true, as in trading, nothing is, but typically if you find a super high yield, there's a reason why they're paying that high yield. Okay, now Uday said it, Annaly Capital, okay, they pay a 11 or 12% dividend. Problem is they are a very, very volatile stock, very volatile. And so you need to be prepared. If something happens to that company, you might not be getting paid that dividend anymore because it might be gone. So these are also things that you need to think about when you start investing this way. So Home Depot, 2.5%, pretty decent there. Haven't been paying dividends quite as long, obviously. 10 years consecutive dividend increases. So, you look at this and you say, okay, well, I got two builders. Okay, they both do pretty much the same thing. One pays, 2.5%, one pays 1.6%. Okay, one has a really long history of paying increasing dividends. This one here, not quite as much. We can kind of look at this here, and you can say, okay, well, they had a tendency through tough times, Home Depot did, of keeping their dividend the same. Okay, so when I see something like that, when I see that they keep their dividend the same, I wouldn't punish them necessarily for that. Okay, this website does. This website basically says if you're not increasing, then you don't get the stars. Okay, but the reality is they've done a pretty good job of increasing this. Now, what was their dividend payout ratio? Okay, so dividend payout ratio 57%. Home Depot can handle that for a while as well. That's not scary. But if you're looking for the more stable, it would seem that Lowe's numbers hold up better. Okay. So we got AXP. Let's look at a few more of these. We'll answer a few questions and call it a night. So American Express. So 1.85%, not real great. Paid dividends for a long time, but don't have a lot of dividend increases. Dividend payout ratio, very low, 26%. Okay. So again, they had 4 years there when the economy struggled, they kept their dividend the same. They did it back in 2001, 2002 as well. So if that doesn't bother you as an investor, if you're okay getting paid the same, then this actually has a better look to it than just the face value that we see. Okay, and they do have the ability with a low dividend payout ratio to continue to pay these. Okay, let's look at a couple more here. WMB, if I can get there. WMB. Kimberly Clark, if I remember correctly. Oh, Williams, I apologize. Williams. KMB is what I'm thinking. So 8.5. Okay. Yeah. Okay. So we got another one. So yeah, it's paying 8.5% dividend, but look at its dividend payout ratio. As far as I'm concerned, this is a dividend cut waiting to happen. Waiting to happen. Okay. And if you look here, their dividends are all over the place. Okay. Struggled in 2003, 2004, paid some really good dividends. One thing I will mention about this, 2015 was about 50 cents higher than this year. So what you're going to find sometimes is one dividend will bleed into another year. Okay, so they might have had an extra dividend payment in this year. If you'd added those two together and divided them by 2, you might see that it was still increasing. But this year was definitely a cut. Okay, but you may see that in some of the dividends you look at. So ET is a good example of high yield, but doesn't have a good history. Yeah, that's true. When I first started, I found a stock that paid a 75% dividend. You soon found out why. Yeah, so that's what I was saying. You get a higher yield, you're taking some risk. Okay, and you know, maybe with something like Annaly Capital, they pay over 10%. So basically, 10 years you got it paid off, right? Well, the problem is it going to be around in 10 years? Okay, these are questions you have to ask yourself. So there's not just looking up what we're doing here. What you got to do is once you find something that you like, then you got to go see if there's any money in the covered calls, if that's what you choose to do. If you're going to be a little bit more than passive, you want to get that cost basis down, because remember, every time you reduce your cost basis, okay, your yield actually goes up, and you're going to continue to get those dividends into the future. So as you sell a covered call, let's say you got Williams here and you sell a covered call and you get a dollar a month. Well, over the course of 12 months, your cost basis is going to come down $12. Then all of a sudden, those dividends that you're getting in the following year are actually going to be a higher percentage. So you have to do that math as well. That's where that compound calculator can come in handy. You can start to do so. When I think about dividend investing, and I start to put things together, like I said, I start to look at a portfolio of stocks that I really like, that I've done the history on, done the fundamentals on, I've seen, okay, this fits my criteria. Then I want to say, okay, how can I reduce this cost basis? Is there any money in the naked puts? Is there any money in the covered calls? Okay, if I can continue to do those things, how quickly can I get myself to break even? That's another thing that really, if you start to do dividend investing, you should keep a really good track of your cost basis. I mean, like to the penny, because at one point in time, you will own that stock for free. It may take a while, but you'll own that stock for free, and then your return is infinite. Okay, so Jimbo asked, do you have a scan recommendation in TOS or FinViz to narrow the picks? Okay, so great question, Jimbo. So in FinViz, I don't scan too much at TOS. I find FinViz to be a little bit better. When you start to do your scanning, let me pull it up there. I'll just quickly show you guys. If you guys don't mind hanging out for another minute or two. FinViz. So when I start using the screener here, there's a few things that you want to look at. So you'll see right on the first page where it says descriptive. Okay. Oh, sorry, I should say. Can you guys see FinViz now? Just let me know if you guys can see FinViz before I start going down the rabbit hole here. Yeah, okay, go on. All right, so right off the bat, you can see that the second column over, second down from the top, there's dividend yield, okay? I like to just start out by clicking it positive, saying, okay, I only want stocks that have a dividend. Okay, that's going to narrow this down. So if I take that away, so we've got 377 pages of stocks. If I just put a positive dividend in there, okay, it knocks it down to 206 pages. So right off the bat, it's going to nail it down for me. Then what I want to do is I want to get my average volume. I usually go over 1 million. Okay, now we're down to 47 pages. So what this tells me is that we've got liquid dividend paying stocks all in the thing here. Then I can start to narrow it even further. All right, I can check out a sector, or I can check out an industry. I can check out current volume. Okay. I can check out, optionable and shortable. I can put that on there. That nails it down another 2 pages. I can put in a price slice or a price, ticker in here as well to say, hey, I only want things, under $100 or over $30 or whatever, right? So if you start throwing those in there, you can start playing around and you'll start to see this stuff. That's when you can start to go to your Yahoo, do your research and kind of put all this together. Okay. So really, one of the other things too that you have to ask yourself is how much dividend do you want? Now, I know there's a lot of the coaches, Gino and I talked about this last night. There's a lot of people that if they don't get more than a 2% dividend, then they just let it go. Myself, I look less at the yield because the yield's going to come from all the other things that I do to it. What I'm looking more for is stability. Okay, so stability I think is very important. You got to be, if you're going to use this dividend investing to your advantage, you got to make sure that these companies are still here in 10 years. Okay, that's probably the first and foremost thing that I look for. But if you want something, you can start, let's say over 2% on this FinViz. I can nail it down. Now we're down to 32 pages. Okay. And so you can add in fundamental. One of the other things, if you go to fundamental too, you can look for, PEG ratios, all that kind of stuff. What I like to look for is institutional ownership. Okay. If you add into institutional ownership, okay, you can put in, let's say over 50%. Okay. So just putting that in alone narrowed that down from 30 some pages to 19 pages. Okay, so little things like that, when you start to scan for these great companies, all of a sudden we're starting to get down. I know one of you asked about ABBV, ABV there, or ABV, I guess they call it. So let's look at that real quick, because I know I saw the ticker symbol in there. So ABBV, so almost a 5% dividend. Doesn't got a real long history of paying dividends. Dividend payout ratio is okay. It's in the healthcare sector. So that's the other things you can think about when you're putting this together is maybe you want to start looking at different sectors as well. Okay. I don't really look at it that way. I'm more interested in the company and what they do more than what sector they're in, but some people like to spread that out. So like I said, not a great history of, not a long history, but so far they do have it increasing. So for all those who asked about ABBV, it's in there. So really that's what you get out of this. There's a whole bunch of, there's a bunch in here. Some pretty decent ones. Aflac, I like that one. There's so many in here. There's 19 pages of this, so you're definitely going to find some decent, decent candidates in here. All right, guys. Any last questions? Any thoughts, comments? Hopefully, this was educational for you guys tonight. Adding dividend investing into your trading routine, it's a great way to get that passive income coming. You know what I mean? Because there's nothing better than just sitting there and basically collecting the income. You know what I mean? When you basically do the work up front, and then you just get paid on the back end. I believe Buffett's Berkshire Hathaway, don't quote me on the number, but I think it's like $70 or $80 million a year they get just from Coca-Cola dividends. So you can imagine how many shares they own. You may not end up being a Berkshire Hathaway, but you can at least start yourself on that path. So, head on down there. So, all right. Great. You guys enjoyed it. Thanks a bunch. Awesome. Love doing this with you guys. Love all being part of the community of tackle trading there. Got to plug my man Gino for tomorrow night. Cash Flow Club for all you members.
Yeah, don't forget that.
Cash Flow Club with my buddy Gino. He's gonna be going deep into some techniques tomorrow night. Don't miss it. It's fantastic stuff.
Yeah, great job, Greg. I just wanted to say I actually got a couple notes and a couple things to add to my repertoire. Hope everybody out there learned something tonight. Last night we talked about basics. Tonight we dug deeper into it. Tomorrow night, guys, how would you like to go into an advanced strategy in the Cash Flow Club where I show you how to do a dividend capture overnight and how to protect your downside when the stock drops? Would that be good? So tomorrow night, I am Greg, going to take it one step farther for you option traders. I'm going to show you how I protect the downside, give myself a great break even, set myself for a good investment or trade, and how to get away with paying little fees to trade on a dividend capture strategy. Yeah, it's really fun. So understanding dividends and how they work is essential. So if you're ready for that, our pro members will get that tomorrow night at the Cash Flow Club. And it's a great strategy. I've done it many times. It's nothing new. It's one of the oldest strategies in the book. We're going to be selling calls. So if most people are qualified to do covered calls, and you could do it in your IRA. So you can actually do these quick scalping of dividends in your IRA, your cash account. That's all I have, Greg. Great job, man.
Thanks, guys. Thanks, Gino. Get in that cash flow tomorrow night. That's awesome. I'm going to be there as well, Gino. That's intriguing for even an old guy like me. So, all right. Have a great night, everybody. Thanks so much. I super appreciate you. Take it easy.